If we compare it to the last 10 years, 2020 has been so far a very disruptive year. Unemployment rate is at 15% in the US, the highest it's ever been in the last 25 years. The S&P 500 fell by 34% on the 23rd of March. At the day of recording, it's still down by almost 7%. But the most craziest thing is that now you see people drawing rainbows everywhere and wearing these weird t-shirts with "Be kind" written on them. You know what I mean? What's all that about? My name is Reda and my goal with this channel is to help you master your mind, money and destiny, bringing you one step closer to financial success. When the last recession started in 2007, I was 20 years old. Knew absolutely nothing about investing and my personal finance knowledge was limited to the belief that money are there to be spent. Then when the recession was over, I noticed that a lot of people suddenly became rich. All this while I stayed in the exact same spot I was before. That's when I started learning more about personal finance because I wanted to change the way I was living. I came across the fact that recessions are cyclical events that happens every 8 to 12 years, when it is a good time to invest because prices are down. On the condition, of course, that you had some spare money to invest. That was the moment I decided to get ready for the next recession by saving as much as I can and learning as much as possible about investing. And now, in front of this new opportunity, it is time for me to share with you my knowledge. The first thing that you have to do to make sure to not fall victim of this recession is to build a safety net in a form of an emergency fund that you can have immediate access to, and that can cover your expenses for at least 3 to 6 months. This is extremely important because the truth is that the next 2 to 3 years will be of great uncertainty. So consider that safety net as the foundation of your investment strategies in this recession, avoiding to fall into investing money that you may need in the near future, then having to sell just a few months later at a big loss. And please make sure to not take out debt to invest. This is very dangerous. You should only invest money that you are sure not to need in the next 5 to 10 years. Another important thing is to not sell your stocks based on panic or emotions. If you have a stock that fell by 30%, your instinct will push you to sell it based on the fear that it may go even lower. Just to be clear, I am not telling you here not to sell. What I am telling you is to analyze the situation objectively and see what will be the outcome on the long term, how affected that industry will be and what are the real chances for that company to go bankrupt. If you have, let's say, an Apple stock, a simple question to ask is, do I think that Apple will be here selling iPhones 5 years from now? Based on my objective research, the answer is yes. And you don't have to agree with me, this is my personal opinion. Yours can be different based on your own research and your own conclusions. But if we speak, let's say, about Carnival stock, which is the biggest cruise line company in the world and was trading in January at $50 while now it's at around $15, in this case I would think seriously if to sell or no, considering that with everything going on, we don't know yet what will be the demand for cruises in the future. We don't even know when they will be able to operate again. That business model went from generating billions of dollars year after year to a flat zero today. To put it simply, no cruises, no money. So be sure to stay rational, not emotional. Another thing is to make sure you buy stocks based on rational decisions. A recession is like going to your favorite shopping center and see everything on discount. Do you want to be that kind of person who gets into the hype of the moment and buy whatever he can put his hands on? Or the person who sticks to the plan and buy only what he really needs? This is clearly a great time to buy, but based on The Intelligent Investor, which is probably the best investing book ever written, even Warren Buffett swears by it, you should invest in the right company at the right price at the right time. That is usually when everybody sells, making the prices really low. The trick is to know what to buy and what to stay away from. And for that you need to avoid speculating as much as possible. We can speak all day long about the future of the cruise industry, whether it will go bankrupt or not. Your belief and mine in this matter is just a form of speculation. But there is way less controversy when we speak about Google, Procter & Gamble, McDonald's, Coca-Cola. These are the companies that are not going anywhere in the next 5 to 10 years. This is the profile of companies you should look for when we speak about individual stocks. Because when it comes to investing, there are only two main rules. Rule number 1, never lose money. And rule number 2, never forget rule number 1. However, I do believe that the main part of your investment should be in index funds. Many things could go wrong with individual stocks, but by investing in an index that follows a big market, you are simply lowering your level of risk. And although nobody knows what an index will be worth in the next 10, 20 or 40 years, what we know based on almost 100 years of stock market history is that on the long term, all big markets go up. The S&P 500 went up on average 10% per year year over the last 40 years. And due to inflation, I see no reason why this growth would not maintain in the future. Index funds are, in my opinion, the best way to invest your money on the long term for high reward and low risk. My favorite fund is the US Equity Index Fund at Vanguard. I like it the most because, in my opinion, it's the one that performed the best in the last 40 years. And of course, there are many other great index funds out there. You just need to find the right one for you. If you are still watching this video, you probably noticed that I only speak about long-term investing. This is because I consider that everything other than long-term investing is a form of speculation, which is just a nicer word for gambling. I stay away from day trading, shorting the market, cryptocurrencies, because I find the level of risk is way too high for me. Call me crazy here, but I find it easier to predict what will happen in the next 5 to 10 years compared to what will happen tomorrow or by the end of the day. However, there is a form of speculation that I find acceptable. It is buying at a big discount companies that got massively hit by the recession, like airline stocks or cruise stocks, at the condition to not exceed 3% of my portfolio. I will just buy them and forget about them for the next 5 years. If they recover, I will at least double my money. If not, well, that was a risk I was willing to take that won't affect my portfolio. One mistake to avoid at all costs is to try to time the market. This is when you decide not to buy today, hoping that tomorrow you will find a better price, which is again just another form of speculation. And to avoid doing this, I will share with you the secret sauce, which is DCA, that stands for dollar cost averaging. This is the act of investing all your money over a long period of time. Meaning that if you have $10,000 you want to invest, you can split it in 12 and invest $1,000 every month for the next year, regardless of the price. The opposite to DCA is lump investing, which means investing all your money at once. Each of these two strategies have their pros and cons, which will be the topic for my next video. But the main advantage for dollar cost averaging is that you are not trying to time the market. You are slowly investing over a long period of time, not caring about today's price. The philosophy behind it is that over a long period of time your investment will balance out. If you buy today one stock at $10, then tomorrow you buy again one stock at $8, and the day after you will buy another stock at $9, your average price will be $9 per stock. And because you are investing for the long term, small fluctuations will not matter anyway. Just go ahead and increase your position regardless of today's price. And whoever says recession says also money traps and scams. This video right here will show you exactly how to avoid them. Make sure to watch it and don't forget to subscribe. My mission is to help you master your mind, money and destiny, bringing you one step closer to financial success. See you next Monday.